Have you ever looked at a price chart, seen two lines cross, and in that moment, your heart beat a little faster? Something just happened. A signal, an intersection between hope and fear, a golden cross or a death cross, depending on the direction fate chooses. I've seen those two moving averages cross hundreds of times on the chart. Sometimes it saved me from a painful crash. Other times it led me into a trap of my own emotions. And gradually I realized the golden cross and the death cross are not just two technical strategies. They are two sides of the market's essence. One is faith, the other is despair. Welcome to Day Trader, where we expose the raw truth behind the waves of the financial market. Here, we don't just talk about profits and losses, we dissect the psychology, mindset, and mental toughness of a real trader. Part 1. When moving averages tell a story. Before we dive into the golden cross and death cross strategies, let's take a step back and look at the essence of what's really happening on the chart. A golden cross occurs when a short-term moving average, typically the MA50, crosses above a long-term moving average, usually the MA200. When that happens, the market may interpret it as a sign of a trend reversal. Prices begin to rise strongly, buying pressure dominates, and momentum can push the price to new highs. Conversely, a death cross happens when the MA50 crosses below the MA200. That's when weakness starts to appear, sellers take control, and prices may fall further. Sounds simple, doesn't it? In fact, that's how technical analysts explain it. But if you've ever spent hours staring at a screen, watching candles form one by one, waiting for each bar to close, you'll understand that these numbers are not just price points. They represent psychology, the crowd's belief, panic, greed, and fear. The market doesn't just reflect fundamental forces like supply and demand. It's also a stage of human emotion where every trade tells a story, and moving averages, in reality, are simply reflections of that story. They retell what has already happened, but with a delay. In other words, the MA50 and MA200 are not magical indicators that can predict the market with precision. They merely help you understand the story the market is narrating, the story of participants, winners, and losers. I remember one morning in early 2021 when Bitcoin first broke above $20,000. The market was buzzing with excitement, and as the MA50 started turning upward while the MA200 stayed flat, many saw it as a golden cross. Social media exploded. Optimistic predictions were everywhere. Here it is. The real bull run begins. Everyone believed new highs were just a matter of time, and forecasts of Bitcoin hitting $100,000 that year seemed inevitable. People started buying, and that belief itself became the fuel for the rally. But I had a different thought. Years earlier, I had learned an important lesson. A golden cross is not a free ticket to heaven. It's merely an invitation to join the game. And like all trading strategies, nothing is certain. A golden cross may offer opportunity, but it can also trap you into acting hastily without reflection. You'll never know whether this golden cross is genuine unless you look deeply into the underlying forces driving the market. Just because it happens doesn't mean it marks a new high. That's why I always stay cautious, waiting for additional confirmation signals before making any move. A golden cross can mark a beginning, but it can also be the start of a great wave. And if you're not prepared for what's coming, you might be swept away without a chance to return. Part 2. Golden Cross, the symbol of hope. When the MA50 crosses above the MA200, it's as if the market suddenly breathes new life, a fresh wind sweeping through every corner. In that instant, the market awakens. The gloom seems to fade, replaced by a bright new light. Big funds and professional players start accumulating valuable assets they've been watching for months. Meanwhile, small investors, anxious and weary from long downtrends, begin to regain confidence. The market isn't dead after all. It's coming back to life. The uptrend has returned. A new cycle begins. Such slogans flood forums, chat groups, and social networks, carrying waves of optimism. And indeed, sometimes the golden cross is a powerful signal that heralds a long bull run lasting months or even years. Those who enter early, just as prices begin to rise, can reap tremendous profits. But there's one thing few people mention. The golden cross usually appears only after the price has already risen significantly from its previous low. In other words, if you wait until the golden cross forms before buying, you'll likely miss the sweetest part of the rally. By the time the golden signal appears, you might find yourself chasing a bus you saw from afar. By the time you run up to it, it's already gone, leaving you watching its tail lights disappear around the corner. I've analyzed many coins and stocks over the years, and the results are surprising. On average, when a golden cross occurs, the asset's price has already risen 15 to 30% from its most recent bottom. That's a big number, and if you don't realize it early, you might miss a great opportunity. Experienced traders, those who can read structure, volume shifts, money flow, and sentiment, don't wait for the golden cross to act. They see it coming long before. For them, the golden cross is merely confirmation of a trend already in place, not the starting point of one. Still, there's no denying that the golden cross carries immense psychological power. For investors who've lost faith after long bear markets, its appearance feels like a flicker of light in the dark. Even the most pessimistic begin to lift their heads again. The market isn't doomed. There's still life, still opportunity. They start to believe that perhaps a real recovery has begun, and that belief drives capital back into the market. From paralysis, the market comes alive again, fueled by renewed optimism. Yet, it's often in those brightest moments of hope that shadows begin to form. When everyone believes the new cycle will last forever, when too much money floods in under the illusion of endless growth, that's precisely when the storm may strike. The golden cross can bring hope, but it also marks the peak of faith. When that faith shatters, the cost is often high, paid by those who trusted the signal too blindly and forgot the lessons of the past. Part 3. Death Cross, the Whisper of Fear. There's a very particular feeling when you see the MA50 cross below the MA200. Unlike the Golden Cross, the Death Cross isn't loud, isn't filled with optimism, doesn't call for faith. It's quiet, cold, like a weary sigh from the market after a long delirium. It's the moment everything seems to pause, hope fades, and silence fills the air. The Death Cross often comes late. It doesn't warn you in advance, unlike the flashy signals of a bright bull run. It only appears after the damage is done, confirming that the uptrend is dead, optimism is gone, and the market has entered a down cycle. By the time traders recognize it, prices have usually already fallen quite far. That sinking feeling when you see the chart break below key support levels, it's like a slap in the face for anyone still clinging to hope. But don't underestimate the Death Cross. You might think it's just another minor signal, that the market will soon recover as it always does. But the truth is, a death cross can precede a long and painful decline. The fall might not last days or weeks. It can stretch into months or even years. Crowd psychology is powerful, and during such times, the market needs a symbol of surrender. The death cross becomes that symbol. As soon as it appears, panic spreads. Investors realize the uptrend is over, and they start selling, cutting losses, withdrawing funds. Fear moves fast. One person sells, another sees it, gets anxious, and sells too. The chain reaction continues. Prices fall not because of poor fundamentals, but because of emotion, collective panic. I still remember Bitcoin's death cross in 2018. That was when the MA50 crossed below the MA200 around $8,000. After that, Bitcoin plunged straight to $3,000, a drop so brutal that many couldn't believe it. Looking back, everyone said, "I should have sold then." But at that moment, most still believed it was just a correction, that the bull market would resume soon. That's the power of the death cross. It tests every investor's faith, and very few pass that test. The death cross isn't a sign that you've lost all opportunity. It's a sign that you need to face reality, to stop letting emotion lead. When you see the death cross, remember, the market is speaking to you. The trend has changed, and it's time to reassess your place in the game. Part 4. Between Light and Darkness. The market always moves in cycles. Where there is a golden cross, sooner or later there will be a death cross. It's an unchanging rule, a loop that never ends. And between those 2 points, between the light of hope and the darkness of fear, lie countless false signals, seductive bull traps, and painful fake crashes. Many traders, beginners and even experienced ones, often see the golden cross as a buy signal and the death cross as a sell signal. It's a simple formula, an easy equation to grasp. When the MA50 crosses above the MA200, you buy. When the MA50 crosses below the MA200, you sell or cut your losses. However, I've seen too many people lose money because of that very simplicity. Because the market is not a computer that calculates every move with precision. The market isn't a linear system. It's a living organism. It breathes, it fluctuates, it reacts, and sometimes it deceives you with false signals. Sometimes the MA50 just touches the MA200 lightly and bounces back, a perfect fake cross. You think it's a buy signal, but in reality, it's just a trap. The market tricks you into believing you're right, then pushes against you once you've entered your position. Sometimes a golden cross appears and you think it's a great opportunity. You prepare to join the uptrend. And right after that, the market reverses sharply, dropping 20%. So what would you call that? A false signal? No, I don't think so. It's simply part of the game. A reminder that only when you understand the human emotions behind the chart can you truly understand the signals. The market doesn't just reflect cold numbers on the screen. It reflects fear, greed, doubt, and faith. And if you only look at indicators without grasping what's happening in the minds of millions of participants, you'll never truly read the real signals. So when you see a golden cross or a death cross, don't rush to act. Take your time to observe, to feel, and to understand what's really going on in the market. Because sometimes the truth behind those signals isn't as simple as it seems. Part 5. Trading strategy with golden cross and death cross. For me, the golden cross and death cross are not absolute signals. They're reference frames, markers that help me see the broader picture of the market, but not the compass guiding every trading decision. I never buy right when a golden cross appears, and I never sell immediately when a death cross occurs. In my world, acting blindly on these signals without understanding the market is risky. I wait. I observe how price reacts around the crossing zone of the two moving averages. I want to see real money flow, not just the illusion of a temporary crossover. For example, when a golden cross appears, I don't rush in. Instead, I check a few key factors. Is the volume increasing? Volume is a crucial indicator showing whether money is truly flowing into the asset. Without confirmation from volume, the crossover might just be fake. Is the price making new higher highs? That shows strength in the uptrend and the potential for continuation. If price fails to break new highs, it could be a sign of weakness. Is the higher timeframe trend aligned? I often look at weekly or monthly charts to see whether the golden cross aligns with the larger trend. If higher timeframes are in a strong downtrend, the daily signal might be only temporary. If all these factors agree, I enter carefully, starting small, then scaling in gradually. Because I don't trade signals, I trade probabilities. Only when I see a high probability of success do I act. With the death cross, I apply the same logic. If price is falling but volume is drying up, it might be the final shakeout, a sign of the downtrend ending. I won't rush to sell. Instead, I wait for a reversal signal in a smaller time frame. If I spot divergence, I'll look to buy against the trend, because sometimes the death cross marks the exhaustion of sellers, and the market may soon reverse. The beauty of the golden cross and death cross lies in their simplicity. But to use them effectively, you need discipline. They require you to slow down, think carefully before acting, avoid emotional decisions, and resist impulsive trades. Sometimes, simply taking a step back to see the bigger picture can help you survive longer in this market. The market isn't a place for haste. Discipline and patience are the true keys to long-term success. If you've listened this far, thank you. Thank you for walking with me through both extremes, the light and the darkness of the market. The golden cross and death cross are, after all, just lines on a chart. But for those who truly understand, they are mirrors reflecting human emotion, belief, and fear. Remember, no signal is perfect. Only your reaction determines the outcome. Learn to read the market with calm eyes and a clear heart. And if this video gave you a new perspective, don't forget to subscribe, share it with others who love trading like you do. Thank you once again. We'll meet again between other crossings, where the market whispers stories that never grow old.